So today's video is on a trading strategy called Russian Roulette. And this is a trade that I just recently saw a video on a variation of this trade that was similar to the way I used to trade this way back in the old days, back when I used to have to walk through the snow for like 10 miles to get to school and life was hard. Back then we only had monthly options that expired every third Friday. That month's option would expire, and on the indexes like the SPX, the Russell, the NDX, it would be AM settled, which meant that on that Friday morning, the third Friday of every month, wherever the options, the first print was at the open, that's where that month's option prices would settle. And they're still there. They still have the AM. Let's just take a look at this. So this is the SPX. Here's the option chain for the SPX. We just had one because I traded it just last week. But if you come down here, you see now they have this is before they had weeklies. Now they have weeklies. They have dailies. And this was before they had any of this. There was basically just monthly options back then. But if we scroll down here, we can see one. Here it is. So here's the May, and you can see that says AM on it. So that's the old school options. That's like the only options we used to have back then. And then they added weeklies and then dailies, and all these, the weeklies and dailies, they expire at the end of day, which makes sense. These though, just these monthly options, the ones that say AM, these expire on Friday, the third Friday of every month at the Friday open, wherever the print is at the open. So back then, this is when I first just started learning about this type of trading, this option income trading. And I was really into iron condors. I thought iron condors were the greatest thing since sliced bread. And I thought I was a freaking genius for making this trade. It was the expiration day trade. And what we would do, and when I say we, I mean me, myself, and I, the three stooges. We would come in here Thursday night, the day before expiration day, like with 5 or 10 minutes left in the day, and we would sell a super wide iron condor, as wide as we could get at the end of Thursday, with the idea being that there would be no trading overnight. You know, the market would shut down. We would put this trade on right before the market closes. The market would close, and then wherever the market opened up the next morning at the opening print, that's where the settlement price would be, and that's where the final price would be basically for these. And the thinking back then was, well, I mean, come on, how far can this thing really move? I mean, nobody's trading the SPX overnight, so if it closes here, I mean, it's got to open up pretty much right there, right? Or close. And look at all this room we can get. We can give ourselves super wide range of room to be safe, and you know, it's kind of like free money, baby. So this kind of a setup, this is similar. This is a trade that I just simulated that expires in one day, but it gives you the same sort of idea. So in this setup, you can see we were making $90, $90 if it lands anywhere within this range from that overnight movement or non-movement, what I used to think, you know, from the close Thursday to the open Friday morning, opening print. If it lands anywhere within this super wide range, we're golden, and we make $90. And the risk is if it lands outside the tent down here, if it moves all the way down here, like between the close and the open, we lose 410 and 410. So I used to do this trade like every month, and I thought I was a freaking genius, and it worked. And it worked like gangbusters until one day it didn't work, and I got my ass handed to me, and I had the wake-up call that maybe this isn't such a great idea. So the problem is that the thing can move. I mean, even though the SPX doesn't move overnight, you know, it closes at whatever 4 or 5, whatever time it closes on the East Coast, and then it opens back up at 9:30 the next morning. And to the novice, to newbie, you'd think, what a great, awesome trade. This is a can't lose trade, because if it closes right here and I put the trade on right when it closes, the next morning it's got to open right where it closed, right? But no, not necessarily. So the thing is that like the settlement number, the price that is used as the final price on the following Friday morning, is where that index settles at, where the first print of the morning. So for example, let's say that we closed Thursday night and a nuclear bomb went off that night. Very likely the futures would bring everything way down. We could totally be way down here, like on an overnight move. And then when the SPX opened on Friday, the opening print would be way down here, and you'd be screwed. And a great example of that is what just happened this last week. So I was planning to make this video on this strategy this week. So I thought, hey, this is perfect, because this last Thursday was settlement day, the third Friday of every month, and the AM settlement was on Friday morning. So I thought, hey, this is perfect timing. I'll just put a real trade on the SPX to help illustrate this whole trade, the pros and the cons of it. So I actually put on a real trade Thursday at the end of day, like with 5 or 10 minutes left in the market. I put this trade on here, this one, live money, real money. Even though I don't recommend this trade necessarily, I mean, I don't advise against it. What I say is just know exactly what you're doing, because a lot of times you'll see videos on strategies and they'll show you all the pros, but they'll kind of like sweep the cons under the rug, and then you have to learn and figure out what the cons are the hard way. So what I'm trying to do is just show you the strategy, and I think it's a cool idea, especially if we can figure out a way to fix it and enhance it. So my idea is to show you the idea, but show you not only the pros, but the potential risks, the potential cons, the potential hazards, and what can actually go wrong. And a perfect example of this is the trade I put on this last week. So I put this trade on the SPX, this one right here, live, real money, at the end of day Thursday, just to help illustrate this whole trade with the idea that, well, I mean, what's going to happen overnight? I can't really imagine like a big 50-point gap up or down overnight. So I put the trade on Thursday night, and about 10 p.m. that night, California time, when I was getting ready to go to bed, I just took a look at the futures, and the ES was down 50 points. And I was all, what? You gotta be freaking kidding me. I mean, talk about Murphy's Law. But actually, it's a good thing because it helps illustrate my whole point and the potential problem with this trade. So what happened after Thursday close, Israel attacked Iran, or retaliated, or whatever that was, and the markets tanked Thursday night, the futures. And we were down 50 points. And if you look at this trade here, this is the actual trade I put on. If you look down like 50 points, right where the futures were trading at 10 p.m. when I took a look at the market that night, it was right here, which would be right at the worst case scenario. I would hit my maximum loss if that price or lower were to print as the opening print the following morning. And luckily, in this situation, it turned around in the middle of the night. So it got way down there, but then like by the time the market opened the next morning, it had bounced back pretty close to where it was at the end of the day Thursday. So I wound up winning this, but I was just lucky. So it's like really important to understand with these trades that it's really out of your hands. Once you place the trade on Thursday night, there's nothing you can do. There's no adjustments you can make. There's no getting in and out. There's nothing. You're just planted in that spot, and you have to be ready and willing to take whatever the market gives you the next morning. So I'm just going to go through the setup that I used to do, and then I'm going to just point out the problems, and then I'm going to look at a way to potentially reduce that risk, and then move into ways trying to figure out how we can reduce that even more, or even eliminate it. Okay, so anyway, so the way that I used to set this up was on Thursday evening, I would go in there, I would make sure that I'm looking at the AM settled options for the following day. This is the one for May. There's not one for April because we just did it, but you would see this, like in Thinkorswim, you would see this little box that says AM. So you just make sure that you use the AM for this one. And then I'm just going to use these that would expire. This is Saturday, so these expire on Monday. So it gives you kind of the same numbers that you would get with an overnight trade like this. Not exactly, but close enough. So I'm just going to open this up. And then what I would do is I would just come down the delta column. See the delta right here? Come down here on the delta column, and I would find the delta that was closest to 10 or under. So in this case, it's this one here, the 48.95. And then I would say analyze sell trade. I would select iron condor, and that would just go over the risk graph, and I would change these the strike. So the 10 delta put is 48.95. You see the 10 delta right there. So I would come to the put to make sure that I'm selling the 48.95, and then I'm going to buy just 5 points under that, the put, 48.90. So that's right. But these calls aren't, again, these are just the default calls they threw in there. So I need to find the right calls. So I'll come over to the call side, go down the delta column to 10 or under. So there's a 10 at 50.35. So I would change the call that I'm going to sell to that one, 50.35. And then I would buy a call 5 points beyond that as protection. So that would be 50.40 right there. And then if we look at that in the risk profile, there it is. You can see that's the iron condor. So this would be the setup. So with 5 or 10 minutes left in the market, I would just try to get as much credit as I can on this. I would send that order in for $90. And usually I get filled. Like I was saying, I just did a live trade doing this last week on Thursday, and I was only able to get $75. But anywhere in that range, from like what you see at the live mark to maybe a little bit lower. But let's just use this as the ballpark for this example. So here's the trade. Let's say we put this on Thursday night before the market closed, and we got filled. So now all we got to do is just go to bed and wake up and hope and pray that nothing crazy happened overnight to move the markets beyond these goalposts here, and that it settles. The settlement number, the first print of the day, is somewhere in this range. And if it does, you get your easy $90. If it doesn't, you're crying in your soup with $410 loss. Now let's look at the reality and the risks that are involved. So again, I'm terrible at math. So if there's any math geniuses out there or scientists and they see some faulty thinking in my math I'm about to do, just go ahead and burn me in the comments. That's okay. But this is how I believe that this all works. So Thinkorswim has this built-in probability calculator. You can see down here where it says price slices. You can set these price slices, which are these brown vertical lines, and you can set them wherever you want. Usually I set like the top one at 10% above where the market's trading, and then the center one here is right where the market's trading, and then I set another one 10% below. Just kind of give me an idea of like where the 10% marks are on a trade, and you can change them just by ticking this there to 10. So in this example, this is 10% above where we're currently trading on the SPX. And down here, this is 10% below where we're trading. But what's cool is that you can see up here, it gives you the probability of this trade landing in these areas. For example, in this trade, this is where we're currently trading. And with these price slices set, this is saying there's a 50% chance it's going to land in this area. It's saying there's a 0% chance it'll land above that, which isn't really realistic, but it's very minute. Close enough to 0, I guess. And on this side, there's a 49.59% chance that it's going to land in this area. And down here, this saying 0 again. So what I'd like to do is I just drag these numbers up here to the structure, the iron condor structure. I'll drag these vertical lines up to there, and then I'll zoom in. I'll zoom in here on the tint. And then I'll move this vertical line here, this price slice, the lower price slice. I'll move it right up to where the break even is on this iron condor, right there, that little red mark. That's where the break even is. That's where the 0 line is. So anything above the 0 line is profit. Anything below is a loss. So that's the break even. So I'll move this line right up to the break even, and I'll put it over there. I'll rest it on that. And then I'll do the same thing on the upside. I'll take this vertical line, come right to the red mark, and so this gives me the probability now of the trade. So now this is saying that the probability that this trade will land within the tent is 43.06 on this one, on this side of the trade, and 41.99 on that one. So if we take our calculator, let's just see what that is. So we'll add 43.06 plus 41.99 equals, okay, so this is saying that there's an 85.05% chance that this trade will land inside the tent and it'll be a success. It'll be profitable. We'll win it. 85.05%, which is pretty good. However, it's also saying that there's a 6.53% chance that it could land outside of the tent and we would have a loss. And there is an 8.42% chance that would land outside the tent on the upside and we would have a loss. So even though there's the probabilities we'll have more winners than losers on this, we need to take that into account because that's pretty lopsided, way bigger loss than what our expected win is. And so if we say an 85% chance, let me just pull out, just to help make sure I don't screw this up, let me pull up my new genius assistant to try to increase the probabilities that I don't get this wrong. So what I'm going to say is, let's just say if I am trading a trade that has an 85% chance of winning, how many trades should I expect to lose after doing 10 of those trades? Okay, let's see what old Chat GPT has to say. If you have a trade with an 85% chance of winning, it means that there's a 50% chance of losing each trade. To find out how many trades you should expect to lose after doing 10 trades, you can calculate the expected number of losses. Then it goes through all this stuff. This is the calculation. So then it says after doing 10 trades with an 85% chance of winning each, you should expect to lose about 1.5 trades on average. This means typically out of 10 trades, about 1 or 2 might be losses. And this is asked us again and use like 12, since there's 12 months in a year. So let's say if I'm traded, I have a chance of winning. If I have 85%, after doing 12, let's change it to saying after 12 of these trades. Okay. And let's see if that changes much at all. Okay. Here we go again. To find out how many trades you should expect to lose after doing 12 trades with an 85% chance of winning. Okay, blah, blah, blah. It's analyzing. After doing 12 trades with an 85% chance of winning each, you should expect to lose about 1.8 trades on average. This means typically out of 12 trades, about 1 or 2 might be losses. Okay, so let's just look at the numbers with 1 or 2 losses on this. So here's the trade again. So if we're making $90, so in a year's time, in 12 months, we can expect to win either 11 times and lose once or 10 times and lose twice. So let's just look at the math on that. So if we're making $90 times 10, that's 900. So we win 10 months, $90 per trade, we make 900, but we lose at 410. So let's just say 900 minus 410 times 2, which is going to be 820. After the year's up, we make $80. So what do you think about that? Is that a good strategy? Let's look at the other one. Let's just say we win $90. Let's say we win 11 months out of the year. So $90 times 11 months. We win 11 months of the year at $90 per win. That's 990. And then we lose once at 420. That gives us a total profit of 570. So 570, if we make $570 on 410, that's a good return. That's over 100% for 12 months. If we make, what was the first one again? I forgot. Let's see. 90 times 10. 90 times 10, that's going to be 900. Minus 840, right? No, 820. $80. So we make $80. Let's see what the return is on that. $80 in profit in a year off of 410 risk. So that's about 19% a year. So that's not too shabby either. Let's just say we hit a weird year and the numbers are at, let's just say we win 90, let's just say we win 9 months out of the year. 90 times 9, it's 810 in winnings. And then minus 3 times 410 is what? I don't know. Let's just say minus 410, minus 410, minus 410. This is where my caveman calculation comes in. Equals, we lose 420. So at the best case scenario, well, the best case scenario could be that we win 12 months out of the year, which would be phenomenal. If we only win 11 months out of the year and lose once, that's still a good return. That's really good. It's like nearly 100%. If we lose twice, win 10 times and lose twice, that's, what was that again? That was about 20% for the year, which is not too shabby. And if we lose 3 times, the max, and again, that's the max. That's the other thing to think about. So we may not necessarily lose the max on each one because you can see it could land anywhere within this line, this kind of slanted line here. And if it were to land, like say right here, you could see the blue number, what that would be. So right here would be a loss of just $28. It would be a loss, but only 28, not the whole 410. Or if it were to land right here at settlement, you could see it would be 189 instead of the 410. So this is just calculating the absolute worst case scenario for these, which may not necessarily be the case. It could be that or better. So the worst case scenario is what we're looking at. So with this one, if we only won 9 times out of the year and we lost 3, we would lose 420 on 410. So we would lose about 100% for that year. So I don't know. That's just kind of a personal thing. Seeing these numbers now, I'm kind of like reconsidering this, or I want them to look at it. Like, is there a way to even increase the odds even more, or even eliminate it? Because I like the idea of coming up with trading ideas, trading strategies that you can just place, especially like on the SPX or the RUT or the IndexX, these cash settled European style indexes. I like the idea of like coming up with a strategy I can just throw on and then just walk away from, like just forever, never have to look at it again. And just with the numbers being in such a way, the probabilities where there's going to be winners and losers, but there's going to be a lot more winners. That's kind of like something I want to figure out this year, and I'm going to do with this channel. And I'm going to go on that quest, that search with this channel, looking for a strategy like that. But so like with this scenario, how can we improve those odds anymore? And if anyone out there has ideas, I would love to hear it. Well, just throw them in the, let's make this like an online YouTube mastermind. If you have any ideas of things that may work to improve these odds, put them in the comments below and I'll back test them and check it all out on the following video. But one idea that I had is, instead of just doing only this iron condor, what about if we gave both of these tails here on this end? And what I mean by that is, let's just say let's add like a put debit spread down here. So let's go back to the option chain and look at the 4890. 4890 right here, and we'll say buy vertical. Okay. And then it gives us this. So this is the iron condor, this is the vertical, and this could also be potentially placed as a butterfly. So rather than put an iron condor on and then a vertical, you could just like sell way out of the money butterfly down here on this side, and then do the same thing on the upside. So for the call side, let's look at the 50-40 call. So we'll say analyze vertical. So we have an iron condor with the there's a 50-40 call there and a 50-40 call there, and on the put side there's a 4890 and a 4890. Okay, so this is that setup. And again, this is just an iron condor with an added call debit spread up here and an added put debit spread down here. And this could also just be two sold butterflies. You could sell a butterfly, a put butterfly down here to get the same kind of effect, and a call butterfly up here. So in this situation, it takes away a lot of that total risk on either side. Now the risk only remains between these little goalposts here and here. And if we add some more, let's add another slice here. We'll say add slice, add slice. Okay, so let's take these and we'll just move these vertical lines up to the break evens on these butterflies here like this. And then I'll do the same thing over here. Looks like we have an extra one right there. Where's that one at? Let's delete that one. Okay, so now let's zoom in and see what these probability numbers say. So now this is saying, here we go. Okay, so now it's saying that between these two goalposts of the iron condor part of it, there's an 84.1% chance we'll win. And between this point here on this lower end of the butterfly down, there's a 4.23% chance it'll land here. And there's a 5.28% chance it'll land up here. So the risk is, and let me kind of narrow these in, get these more tuned in. And the same thing with these. I mean, this is, we could lose anywhere along this blue line. So the absolute worst case scenario, which would be a super low probability, I think, would be if it landed right at the tip there, which is 453 on that one, or right around there. On this side, it's about the same, 450. Let's just say 455. So this is saying there's a 2.2% chance it'll land within this area here. And if we were to move this like to the tip, would it give us a number for that? .22%. Let's just say 1%. Just, you know, caveman math. So let's just say there's a 1% chance it'll land at the peak, the worst possible scenario, or we can just say 2, whatever. And on this side, let's move these in. So there's on this side, there's about the same. There's like a 2% chance, 2.5, 2.05 down here, 2.457, 2.47 up here. So let's just say in general, just be like conservative. Let's say that there is about a 5% chance or less that it'll actually settle in one of these V's in one of these canyons. So let's go back to our genius assistant and say, similarly like what we did last time, let's say if I'm trading a trade that has let's say 95% chance of winning now, right? 95% chance of winning, right? Because there's like about 2% here that we could lose in this area. There's about 2.5 in this area. So that's 4.5%. Let's just be extra, give us some extra room and say 5%. So if I'm trading a trade that has a 95% chance of winning, how many trades should I expect to lose after doing, let's say 12, because there's 12 months in a year. And let's see what that says. My assistant's doing all my calculating for me, all the hard work. Okay, so it says, after doing 12 trades with a 95% chance of winning, you should expect to lose about 0.6 trades on average. This means typically out of 12 trades, less than one might be a loss. Okay, so half 0.6. So it's saying that out of 12 trades, after a year's worth of trading this once a month, every month, once a month on AM settlement day, there's about a 0.6% chance that we could lose. And not even the max, right? The max is going to be less percentage than that. It could happen totally, but we have all this area of loss where it could land either on either sides of this blue line. So the loss will be either the worst case scenario, like 455 or less. And that makes this a little bit more enticing of a strategy. The thing is, though, because since we added these other legs down here, the profit target is now only 35. So before we added those, we were making 90 bucks on 410 loss. If we add these guys, it's the total profit potential is 35. So a little less than half of that. But still, let's just do the math on that. So let's just say if we won 11 months at 35 bucks equals 385, and then we lost 0.6. So let's just say half of the total at risk is 450. So that would be 225. Half of that would be 225. So minus 225, we make 160 bucks on 455. If we lost 3 times, say we won 35 bucks times 9 months out of the year, and then we lost minus 225, minus 225, minus 225. That's more caveman calculating for you. Equals minus 360. So that's kind of an interesting idea to look at. And there's probably more. If you have ideas, put them in the comments. I'd love to see them. And I would test them out. I'll test them out for a future video. I'll include them in there. And there's some other ideas I have too of ways to cover this area. But I'm going to get into that in a future video. I'm not going to do that on this one. This one's already too long. So anyway, that's just my trade called the Russian roulette trade. And it's not really like Russian roulette because you're not going to get killed on a loss, but you're going to get damaged. So let's call it like Swedish roulette, or what's the nicest country in the world? Antarctica. Let's just call it Swedish roulette for now. My wife's Swedish, her whole family's Swedish, and they're all pretty nice. So anyway, that's the trade again. It's the AM settlement trade. It's the old school style where we use the old school options expirations, which are still being traded every month on the third Friday of every month on the indexes. You'll find the AM settled. So we're just taking the AM settled trade. Thursday night, we come in there. Third Friday of every month. The Thursday before that Friday, we come in at the end of day, like 15 minutes left before the market closes. We place an iron condor as wide as we can get it, or whatever you want to do for your own preferences. And then we just hope and pray overnight that nothing happens and that it'll land in this area at the settlement number the next day. And you can find the settlement number for each expiration by just going to, like in Thinkorswim, go up here to, well, let's go to the trade tab. And let's type in set, S-E-T. So this shows you the last, what is this going to show us? Nothing. So this is going to show where it settled yesterday, Friday morning, for this last week. And so every third Friday of every month, you can come in here at SET and see where the SPX settled for that expiration. And I think it takes an hour or two for it to actually post. So that's the Swedish roulette trade. Let me know in the comments what you think about it. And again, this is a trade. I'm not recommending this trade. I'm not recommending that you don't trade it. I'm just neutral on it, like Sweden, right? It really all just depends on your preference, what you're trying to accomplish, your risk tolerance, all that stuff. An important thing is that you just understand everything that's involved with it, all the risks, all the pros and the cons. Because too many times on these videos on YouTube, I'm seeing folks touting a strategy and either they don't understand themselves or they're just not talking about it on purpose, all the potential downsides. So I just want to put all the cards on the table with these strategies so you can see everything, the good, the bad, the ugly, and just have an informed decision before you begin to trade it, before you even decide to even paper trade it. Is this a strategy that you would be comfortable with? I mean, think about with this trade, when we zoom back and we see the bigger picture, how many trades over a year, those returns, some of them look pretty good and some of them look okay. But is it really, if you think about it, is it really digestible? Let's say that you were to start to trade this and it's just one trade a month, right? So your first month, you put your trade on, let's say that first month is one of the losers. You lose it. So now you're down $410 or whatever it was. And that means that you're going to have to win 4 or 5 times in a row just to get back to break even. And could you handle that mentally? I mean, would you still be motivated to trade that every month? Knowing that it's a half year is wasted, or there's 6 months here, 5 months, five or 6 months where you're just going to be clawing your way back and you're going to be underwater for all that time. Or even worse, let's say you hit 2 losses in a row, which is totally possible. At that point, you'd be down 2 times. Let's say at the beginning of the trade, your first 2 trades were losers. Or let's just say your first trade was a loser, then you won one, yay, and then your third trade was a loser. I mean, these are all possible scenarios. There's no rule that says the losses and the wins have to come in any particular type of order. So in that case, you're down right off the bat. Your first trade, you're down 410. So your next trade, you make 90. So you're kind of clawing right back. Okay, the sun's back out. Everything's looking good. But then you get hit with another loss. Now you're down $700, $800. And so now for the rest of the year, basically, all the remaining months of the year, you have to win every single one just to get it back to break even, not even without any profit. That's just to get back to break even. So is that something that you could handle or that you would want to handle? Is that a trade, a situation that you would want to put yourself in? Then, of course, there's also situations where maybe you just take a small amount of money, just understanding. The main thing is just understanding that, what it would really be like, not just being enchanted, hypnotized by return numbers, but actually get down in there in the trenches and imagine how that will really play out. It kind of changes the whole thing. So anyway, that's it for this one. If you found any value in this video, and also if you'd like to follow me on trades like this one or any of the other trades I'm doing, just make sure that you're subscribed to my YouTube channel. And also be sure to join me on my website, join my free email newsletter. Just go to my website. I'll leave a link to my website in the description below. Head on over there, sign up for my free email newsletter. Then as soon as you do that, you'll get a welcome email from me. Just reply back to that welcome email. I'll get back to you and we'll go from there.